Hi, you're listening to Cam Dadwar from the Trading Framework. I'm just going to do a video on custom profiling to show you how to use the profile indicator in Market Delta or Investor RT to help define areas of value and define where the value area high, value area low, and the volume point of control is. So what I would do is I'm going to start with a daily chart and then we move to a longer time frame chart. And we'll go a little bit further back to some balance that we had on the E-mini S&P. This basically applies to any product and any time frame, but I want to display a number of time frames just to give you a good feel for it. So what we will do here is start defining where balance and value was. Admittingly, it's easier to find balance and value after it's occurred, but the trick is to find it as and when it's occurring in real time. But if you know what you need to look for in price action, you will be able to find it. It's actually relatively easy to find in real time. It's just a matter of reading the price action and understanding what you need to see. So firstly, what I want to do is basically use the profile indicator, and I've got a button set up in Market Delta, which is here, PROF. Otherwise, what you can do is show the toolbar, and you can use the profile drawing tool by clicking this button right here. So that should do the same thing because that's my default. Or I can just hit this button. It's just easier for me to use this button because I normally hide the toolbar. So what we want to do is basically find price action that is sideways, and we define that by a swing up and a swing back down, which is 80 to 100 to 120% towards that low. So that's a rough guideline. So basically a swing up, if it pulls back nearly all the way to the last low, that's about 80%. If it gets right to that low, it's 100%. Sometimes it just tests below it, so that's why I say around 120%. So we get like 80% here, 100% here, 120% here. So it's just a good guideline for you to get an idea of when to take the levels and understand the market is balanced. Now, if this goes back into the high again, about 80%, 100% or 120%, it doesn't always go right back into the high. Sometimes it stops just short of it. Now, if it was to go back and only pull back like halfway and then start reversing back up, that's not quite a full rotation. We want to see nearly a complete rotation or just over a complete rotation. So the markets are not perfect, neither are we. So, we don't have to look for textbook examples, but, if you use this as a good guideline, you should be able to find them. So if price action moves down first, you look for a retracement back into that high. And once you see that, you generally should be able to see the potential balance starting once we start to hold that high or near it and then come back down. And you generally got a good idea the market's found balance once that happens. If it makes a new test of the low again, then you have even further confirmation that it's a balance range. But you don't want to wait until you've got multiple tests of the range high and the range low, because then you're leaving it too late and the opportunities may have already passed. So you want to find it early on, and usually after the first couple of swings around a potentially sideways balanced range. So it's basically just a sideways price action range. You can see price moves down here, about 120% retracement past that swing high, comes back about 80%, 120% again, and then it makes a very small consolidation range, pops up. That more than likely is a Fibonacci retracement extension, which is about 120%. Again, is 127.2, but that's another video. So we come back down again, make about 80% retracement back in this low. We come back up again and we basically make an extension. Now, a Fibonacci retracement extension is covered in another video, so I'm not going to go through that right now. That's more than likely a 161.8 extension. And then we back into the lows again, so it's around about 100% retracement. So the market is balancing and it's sideways. So whenever you get the first sign of potential balance, which will probably be after this swing up, swing down, swing back up again, you can basically take your custom profile around that range. So initially it will start off like this, and then what you want to do is go into the settings of the profile and then change the time per profile. This is in Market Delta or Investor RT, it should be the same options. Now, if you're using another piece of software, NinjaTrader is quite popular. Sierra Charts is quite popular also for profiling with my students. Now, if you use that, you just need to find out how you can set your profile to build until the present moment, so it's real time. So however you do it in that software, you need to set it to keep building in real time. So because right now we're looking back, in the past, but what you want to do is recognize balance value real time and put it in and let it build and automatically change its value high, VPOC value low, and basically keep distributing volume around that range as the market keeps trading around it. So what you want, right now it's pointless me putting it to present because that's going to bring it up to where we are right now today, which is around February 2015. So we don't need to do that. Just want you to get the idea that we start the profile there. You can see it went across balance for quite some time, October, November 2009 right here, until like August, September 2010. We kept moving higher. It's a daily chart. You can see balance here again, started at the beginning of the range. As soon as you see, that's gone into present, but let's just put the profile back on. Now, if that happens like this, and you want to just put it around a range that previously was traded, just change it back in market order to custom, and that will put it to the point where you actually drew the profile to, which is around about here. It doesn't have to be exact. You want to get roughly the beginning of the range and the end of the range. So what you'll find here is we did again rotation down, up, about 120% retracement, 80% retracement, 120% retracement, 100% retracement. So you can see how the market balances and finds a sideways auction. But we want to identify where the value is because that gives us an idea of where we should look for longs and shorts. The idea is to find longs below value and shorts above value. Now I can set this as my default actually. I'll just do this for now. Okay, so now we can keep going forward on the daily chart doing the same thing. Now let's just move forward to where we are right now in this market. And what we can see, we've had balance recently since October, actually November, December, going into this area right now. We can see there's not a lot of volume up here, so it's not necessarily attracting trade up there yet. So we could potentially get a rotation back down into value again, and that's typically where the opportunity is. Now this is a daily chart, so that's for a swing trader, position trader, holding anywhere from a few days to a few weeks. Now we can see the market has already traded around this range. And again, another example, retracement low, 120%, 80%, 80%, 120%, 100%, 80%. And this is just over, it's probably about 120 from above this high. Now we use Fibonacci retracement extensions to actually measure where exactly the market can go to, but then we fine tune that with low volume areas. In the next video, I'm going to talk about composite profiles where we actually get the levels from, because we don't want to just be short above value and long below value. We have to find specific points for trade location and to improve our entry and timing around these areas above and below value. So we don't want to just buy as soon as the market gets below value or sell as soon as it gets above value, because whilst we typically do get the rotation back down or back up, back down from the value or high, back up from the value or low, you can't just take unlimited amounts of risk. So you don't want to just start getting long and just hope and pray that it goes back into value, because sometimes it's not going to do that. So we do need to see setups below value and setups above value. So that's a daily chart on the E-mini S&P. Now same kind of thing, it doesn't matter what time frame it is. This happens to be a 30-minute chart, but again, just a couple of more examples here. Custom profile there. That range broke out. Whenever we start seeing the market going out of the range and we start seeing distribution on the profile in real time, basically that's a sign the market is finding new balance, new value there. And as you can see, the price starts to rotate sideways there again. So whenever we see that, we split the profile. So I would get rid of this profile as soon as we see distribution higher outside of this area, because the profile should look like this. It should look like a bell curve. It should look like very distributed in the middle, within the value area, and above there should be really no interest. Up here, this volume profile should be flat as it is below, right? But the fact that we actually accepted up there, that means there's potentially new value, or the market's changed its perspective of where value is. So when that starts to happen, you start taking a new profile around the range, and then you trade around that new range. And again, you trade around it until the new area develops, which you can see here. We had another area above, then you trade around that one, and then you have another area right now. More recently, we have one just below. And you can see how the market auctions around it. Like initially you'll get the range from this swing low to this swing high, so this swing low, and so you'll pick these points here, here, and here, and up there for the rotations down. So typically you get about a good 3 or 4 rotations around the value area before it breaks. Basically, the shorter the term the profile is, so these are quite short term because they've only been there for like a day. This one above, therefore about nearly 2 days, spanning over 2 days. This one here started yesterday, goes into today. Generally, the value areas last anywhere between 1 to 2 days for very short term activity, but the best opportunities around those profiles that last typically anywhere between 3 days to 2 weeks, and like this is a good example of that. And you get the best risk reward opportunities around those ranges because they typically bring in more longer term market participants because the range is developed over a longer period of time. So people show more interest in that range because it's wider, it's been there for longer. Whereas the shorter term profiles, like the very short term profiles, like if I was to move to a 5-minute chart, you'll see lots and lots of very short term areas for trading around in value. But that's more of a scalper's time frame. I don't personally go that low, but some of you guys might be scalpers. So if I change that to 5 minutes, take a little while. You can actually see it's probably just a little bit more detail around the range that we already had. So you can just see here we started the range and we've been trading around it. But you can see how the market, trades here, the unfair low, the unfair low. So the buying opportunities seem to be evident there. And then the value are high, back down again. This one looks like it's popped up a little bit, come back down. This is a scalper's time frame, so that pretty much would be enough for a scalper on the E-mini S&P. So in the following videos, in the training course that's going to be introduced to you in a few emails in here, you'll recognize that there's a scalping module and also a swing position trading module. So it teaches you how to apply the framework for swing position trading, for day trading. I'm a day trader and I look for the 1 to 2 main swings intraday. They typically happen most days, sometimes they don't, but generally there's a 1 to 2 main swings intraday in the morning session. That's what I look for. There's the best risk reward opportunities and you have to just be very patient with them and disciplined with them. But typically you have to observe from a 30-minute chart perspective and higher to find them. Now here's a very short-term chart which is actually on a Renko bar setting. And it has a Heikin-Ashi bar overlay. I use this for shorter time frame price action analysis. But again, same kind of thing. You can take the custom profile and as a scalper, you can scalp around these ranges. But the concept remains the same. Find sideways price action, find where value is, and you can see how the market then trades consistently from above value back down, from below value back up. And then we have the range extension, which is when the Fibonacci retracement extensions come into this. Then when we do find the new value area, which will be present with price moving up firstly, but if I drag this volume profile across, you'll see how it started to accept in this area. So you can actually see it starting to accept there, and that's when you break the profile, you remove the profile, you put it back in because you want to remember where that value area was, like I put it in back there, and then you look at the new value area, which started here, looks like it transitioned a little bit higher, and then continue to build around it. But you basically get used to trading around these value areas in real time. So that's basically how to draw custom profiles and find them on multiple time frames. I've just focused on one product here, the E-mini S&P, but it's the same on any market. Every market is an auction. Every market develops value. Irrelevant of the fact of whether people believe it or not, if a buyer buys a market, they must have a concept of value because they think that market's going to go higher. If a market participant sells the market or shorts the market, they must believe that market's going to go lower, assuming they are trading outright positions, meaning they are basically in that contract, in that market with a naked position. If you're hedging or spreading positions, you typically manage your risk also through hedged products and hedged trades. So you'll be long and short two different products at the same time. But without taking that into consideration, what we're looking at here is outright trades where you are looking to buy a market because you think it's going to move higher. You're looking to short a market because you think it's going to move lower. So that's the opportunity. So there has to be a concept of value. You must believe the market should be higher in order to buy. You must believe the market should be lower in order to short. And that's how this basically becomes very effective, because not a lot of people look at value. Not a lot of people understand auction market theory, but it seems to be becoming more and more interesting to traders, and actually a lot of traders are moving towards this style because there is a lot of it makes a lot of sense firstly, but there's also a huge edge there. So if you can see the market from this perspective, you can recognize the auction, you can actually take advantage of these opportunities. So the market, basically its job is to facilitate trade. So it actually wants to find value because it wants to distribute trade around a certain area where market participants actually find it interesting to trade around. And basically we find interest when volume builds at price, and it's proven through volume, because the interest of the exchanges is to bring in as many market participants as possible for that particular product. And the more market participants doing business in that product, the better. So the market is actually most efficient when we can actually facilitate trade in the range. But the interesting thing is, the area where most people do business in the value area is actually the worst place for trade location. The best place for trade location is where most of the transactions don't take place, which is above and below value. So that's actually where our opportunity is. That's why, I suppose you can look at it as a way to understand why, the majority of market participants don't make money, because they are trading and transacting within the middle of these ranges where, the best deals, the best opportunities are above and below these areas. So I'm going to move on to the composite profiling on the next video, and I'm going to talk about how to find the levels below and above value.